Chapter 8, Depreciation. As a refresher, we have long-term assets. We've talked about accumulated depreciation. We've talked about depreciation expense. Land is not depreciable. Buildings, machinery are. Accumulated depreciation is total depreciation expense added up over time. It's a contra asset account. All these items are presented in the financials. So assets with the contra asset amount are presented in the financial statement called balance sheet. Depreciation expense is an expense and it goes on the income statement. So net book value would be building less accumulated depreciation as an example. Depreciation expense is the annual cost of non-current assets. Because we don't buy a building and pay like $10 million and expense it. We expense it over the life of the asset, following the matching principle that we learned about in the first chapter. There's some things that we can do that you don't know about until you take a class like this with what we call capitalizing. In other words, the cost of building, the cost of equipment. Maybe more than just what we bought the equipment for. Let me just go into an example here. Listed or below are certain costs or discounts incurred in the purchase or construction of a new plant. Indicate whether these costs should be expensed or capitalized. Capitalized means they are included in the cost of the plant asset on the balance sheet. And if they're on the cost of the plant asset on the balance sheet, they are depreciated. So the question is to expense now or to expense later. Really, that's what we're doing. We're capitalizing and expensing over time later. For costs that should be included in the plant assets, indicate which category of plant assets, equipment, building, or land, the related costs should be recorded on the balance sheet. Charges incurred to train employees to use new equipment. That's capitalized, believe it or not. And it's equipment. It says so right there. So training employees on the use of the new equipment that's being installed that we just bought, you can capitalize that. So in other words, we pay the employees, but we don't expense that labor. We'll then, like we would payroll, we'll depreciate that labor cost over time. Obviously, the invoice to purchase the new equipment is capitalized. So number 2 is capitalized and equipment. 3, deduction for early payment discount taken on purchase of new equipment. Well, that's a reduction in cost. We still call it capitalized, but we're going to reduce the amount we're capitalizing by that amount. We still call it capitalized, and it's equipment. Real estate commissions incurred on the purchase of the new, on land purchased for the new plant. Land is not depreciated, by the way, but it doesn't change anything that we're answering on this question. We still capitalize the real estate commission, and it's an asset category called land, and we know land is not depreciated. Once more, property taxes on land incurred after it was purchased, that's an expense, and there's not an asset, it's an expense item, so it's not applicable. NA. Cost of tune-up for truck. Now look, this is just regular, normal, routine maintenance. That's not capitalized, so we're not going to capitalize it. And it's not applicable because there's no asset category. Cost lay foundation of a new building. That's capitalized. It's not land, it's building. Insurance on new building during the construction phase. Capitalized building. Duke Energy. They build a new electric generating facility. Interest on new building during the construction phase. Capitalized building. So sometimes even the interest on the loan used to build a new building can be capitalized in certain circumstances. So it's not just insurance for number 8, it could be interest. Let's look at a problem. Rezio purchases a machine, and I normally say, hey, y'all read it, but I want to walk you through this one. Purchases a machine for $12,500. Terms 210 net 30. So if you pay a discount, If you do take advantage of the discount, pay it off, pay it in full in 10 days, you get a 2% discount. Let me just say it that way. Otherwise, do it in 60 days. Freight on board, shipping point. The seller, not the buyer, prepaid the freight charges, so there's nothing there for us as far as calculating that for capitalization. Adding the amount of the invoice. Wow, I'm bringing the total to $12,860. So they charge the shipping. All right, well there we go. It's going to be part of the cost then. The machine requires a special steel mounting and power connections costing $8. I knew that was the answer. I was just trying to walk you through it. So yeah, it's going to be part of the cost. We're going to have to add it in. Power connections costing $8.95. Let me rephrase that. We get to add the shipping cost or capitalize the shipping cost. Special connections and installation costs $8.95, $4.75 for assembly, $180 for damages. That's an expense. That's a repair. That's not normally customary part of installation of this machine, so that's an expense. That's not capitalized. Materials costing $40 to adjust the machine. Yeah, that's normal and customary to get it set up and running correctly. The adjustments are normal for this machine are not the result of damages. Yeah, just for the clarification, I was fixing to say as long as it's normal, and I did say that, but not the result of these damages. I was fixing to add that, and then I read that. All right, so the compute the cost for the recorded from the machine. So the invoice less the discount. We talked about that already right there where I did a little circle thingy. So the net purchase price is $12,250. We just talked about that in the prior problem. Deduction for the early discount. This is an early discount, early payment discount, right? Just worded differently. Transportation, seller paid it, but they added to the invoice, so we're gonna capitalize it. Mounting and connections, assembly, materials use was $14,020, and then the repair charge. That's not normal. We had a whoopsie, and whoopsies are expensive. All right, so could be our error. Yeah, it sounds like something happened once it was on our site. So, and we just, crane or whatever, bumped something. And it was for a $14,000 machine, $180 damage. I'm not going to complain about it. We probably budgeted more for maintenance and repairs than that. In general for the operation at this company. All right, so we have different types of depreciation. There's many different ways of depreciating equipment. We can do what's called straight line. We can do what's called double declining. And then we can do what's called units of production. Before we talk about those, let's talk about book value. Book value is the cost less accumulated depreciation. So if you have a $10,000 piece of equipment and it's $1,000 accumulated depreciation, the book value is $9,000. Okay. So let's look at straight line. I want to emphasize that with straight line, it's the same amount year after year after year. So once you calculate depreciation for straight line, it's the same amount year after year after year. That is not the same with double declining. It changes every year. And then units of production, obviously, if the units of production were the same identical amount year after year after year, then that would be the same. But because that's probably not likely, it also is not the same. So B and C, the answers for each year are not the same. A is easier. B and C would be harder. Okay. The neat thing about the double declining is the way we calculate it. It actually starts off as straight line and then doubles. Let me go over that with an example. If we have 10 years of service, right, and we divide it by 10 years, 10%. I think I did that right. Yeah. And then we would double it, and it would be 20%. I think I did that right. I like this here though. So if it's 10%, yeah, it'd be 1 out of 10. Yeah, I should have did this. I did. I had a 10 on top. I didn't mean to do that. Something didn't look right after I wrote it down. So 1 out of 10 is 10%. We double that as 20. So 10% would be here, straight line, and then 20% would be here. The thing about straight line is it's 10% every single year. Double declining is not, because of this. If it was double, then it would just be, so 5 years would be, 10 years would be 5 years. But we're going to decline it every year. All right. One other thing, this is not on your test, but it's an FYI. A lot of the tax tables that the IRS uses for accelerated depreciation for business income tax purposes use the double declining balance. I got a couple of minutes left, and I don't think I have enough time. I try to have a self-imposed 10 to 15 minute time lapse on here. If I try to go to 15, I don't think I finish this problem, so I'm going to create another video after this. So we'll start on problem 828. If you could go ahead and read this before the next video, that would be great.